are focusing on Aarti Industries. In our conversation right now, Suyog Kotecha, CEO and Executive Director, joining us on the show. The stock up right now. Numbers tad below expectations, but reasons for those as well. Let me just go through the numbers first. Year on year, revenue up 6.2%. EBITDA was hit about 11% down. Margins came off from 15.01 to 12.6%, and net profits were also down 62, nearly 63%. Mr. Kotecha, thank you so much for speaking with us. I believe one container spill in the third quarter has also been in part a reason for the kind of numbers we're seeing.
Yeah, no, I think if you look at the numbers on YOY basis, definitely there is a hit on EBITDA, but on a quarter-on-quarter basis, we've actually grown by 17%. I think from 202 to 236 crores. So we're seeing recovery from the last quarter. Volumes are up, both energy businesses as well as non-energy business. We are seeing volume up. And demand is steady across most of the end markets. And we hope to see continuation of this trend in terms of recovery going forward.
Let's talk a bit about the energy business, which has seen a robust growth, I think better than the non-energy business. Are you seeing this continuing into Q4? And what are the sort of factors in Q3 that have seen an impact which you don't think will sustain into Q4?
Yeah. No, our energy business is a relatively new business that we have grown in the last 2.5 year time frame, continues to see good growth. I think it's linked to ultimately refinery economics, most importantly gasoline naphtha spreads, which we are seeing on an improving trend, especially in Q4 as against Q3. There are 2-3 things that have happened. We have targeting now much wider set of customers, much wider set of geographies for this particular segment. So that is starting to give results. We have also increased our capability to do large volume shipments for this particular business, to US, to Europe and Middle East markets. That is also helping us. For Q2 specifically, this business had sort of gone down in terms of volume because of the end market dynamics. And in that context, we had accumulated certain inventory of raw material, which got liquidated in Q3. So that will also not be there in Q4. So overall for that business, we see good momentum getting into Q4.
Suyog, good morning. I was going through some of the excerpts of your con call as well, right? There was a lot of people gleaning very carefully what's happening to specialty chemical commentary, because some companies have pointed out to slightly better times, slightly improved pricing, etc. I didn't find that in the call. Is it true that for now you believe it is ceteris paribus, or do you believe that no, there is an improvement ahead, consolidated company-wide, I'm saying?
Yeah. No, look, on a consolidated company-wide, there's definitely improvement. But I think as we give the commentary out, it's important to highlight underlying challenges for the sector as well, right? On a demand side, we are seeing steady growth across end markets, even on agrochemical side. As I had mentioned, the inventory destocking story across most of the end market is complete now. So on a volume growth, I think we have been very consistent on what we are saying versus what we are delivering as well. I think on the margin side, it would be fair to say that the pricing pressure will persist for some amount of time to come. The overcapacity that has got built in China is quite large in nature, and that is not going to get absorbed in 1 or 2 quarters. So I think we have to get used to living in this pricing pressure kind of scenarios for a few quarters until the demand catches up, which will potentially take a few quarters. The meaningful margin recovery is some time away, right? I think the sector has got used to significantly high margin in the past, which have got compressed in the last few quarters. And from that point of view, we thought it is prudent to say that the volume recovery will continue, but the margin recovery will take some time.
Okay, so Suyog, 2 questions here. One is, when you say a few quarters, is it less than 5? Is it above 5? What have you? If you can guesstimate, right? Part 1. Part 2. The margin issues, right? Now I can understand post-COVID there were a lot of one-offs, buoyant demand, which led to the margins going up. But when I look at your numbers, even in 2017-18, you used to enjoy 20-21% margins. You've come down to 14-15, and you're guiding to the long-term margin picture of 14-15%. Am I to therefore assume that margins will probably stay in mid-teens, 14-15%? For next 2-3 years, or could it improve once pricing improves?
I think as a management, the guidance that we are giving is based on the current market situation. And there are certain value chains in which we are present where there is a huge amount of capacity buildup that has happened in China. I think the global demand needs to pick up. Now, if the global demand continues to grow at, 2, 3 odd percentage versus the overcapacities in the tune of, 20, 25%, then you can imagine it will take, 2 to 2.5 years for utilization levels to reach to some respectable level from where the margin recovery starts. I think we've been prudent in terms of our guidance especially for the mid-year kind of time frame, 3 years kind of time frame. We might get surprised with the earlier margin recovery, but at the same time, given our observations over the last 4 to 6 quarters, we think that it was appropriate to get a guidance based on a 15% odd kind of EBITDA margin numbers, and then we will continue to watch out for how Chinese capacity situation pans out over the course of next 4 to 8 quarters.
Mr. Kotecha, what is your volume growth outlook looking like on a consolidated basis and among segments?
So we are roughly tracking right now 9 to 10% kind of volume growth for this year, and across all segments put together. And even in next year, we are budgeting in somewhat similar kind of volume improvement. Obviously, it is getting supported by our new capacity expansions. I think we recently commissioned nitrotoluene and ethylation chain capacities in the last few months, which is now getting ramped up in Q4 and will continue to get ramped up over the coming quarters. We are also commissioning a new greenfield site in the next financial year in Jagadia. That will, of course, take a little bit more time to reach certain utilization levels from a commercialization point of view, but that will also add significantly to our volumes in the next 6 to 8 quarters.
Greenfield site, which product category is it for? Any details there that you can share with us?
So it's a complex site with roughly 30 to 35 odd kind of different product slates, mostly going into specialty domains of pharma, dyes, and agro. Broadly, from a value chain point of view, we are focusing on chlorotoluene, dichlorotoluene kind of chains, and we go multiple steps downstream, 4 or 5 steps downstream in terms of the sort of base molecule. And the way we are constructing that site is a little bit of flexible site in terms of ability to produce different product depending on the market and sort of demand and margin patterns, right? So I think that will give us a good amount of flexibility to manage market volatility as well going forward.
Just trying to understand, Mr. Kotecha, because we've spoken a fair bit about China impact, what happens with dumping there, etc. But the other big factor is global demand, tariff war, what's coming out of the US. Just trying to understand how all of this impacts Aarti Industries. Are there positives and negatives, or does it spell bad news if we do break out into a global tariff war? What happens if China is primarily at the receiving end of those tariffs?
I would say it's a bit premature to comment at this stage, given how fluid has been the situation over the course of last 2, 3 days. But in general, if the attitude towards China remains what we have seen in the last few days, then it will of course be beneficial for Indian chemical industry and for us as well. I think there's a decent amount of our exports, especially in the agrochemical and polymer space, that lands up in US. And if whatever has been announced so far, if that continues, then that portion of the business will definitely say sort of increase traction both from demand as well as from a margin point of view.
Suyog, sorry, I just want to probe that a bit further, right? Just trying to understand. So if there are tariffs and significant tariffs on China, China may retaliate a little bit. There are two aspects to this. One is if China would dump some of the capacities which maybe erstwhile might have been going to US into other places, could there be significant pricing pressure in your end markets, including India? Part one of the question is that. Part two, we've almost forgotten about a China stimulus, right? And if China were to stimulate, could some of their own capacities be used internally? And could that reduce pricing pressure? I would love for you to tell me both of these aspects.
So look, if you really want to probe further, I think there are multiple aspects here happening in the market, right? So I think one dimension is US imposing tariffs on China, which has, of course, from China export to US getting, priced at slightly higher levels. The second aspect is in that context, the trade flow shifts, right? So the Chinese capacity will have to find a way to get placed into the other parts of global market, which will mean increasing pressure in markets like Europe, Japan, or India, for that matter. The third aspect is currency, which I think sometimes we tend to forget, but the relative depreciation of INR versus USD versus Yuan versus USD. And in that context, INR versus Yuan, I think that will also play a role in terms of export competitiveness going to these developed markets. And the fourth aspect is the domestic growth in China itself, right, driven their stimulus. So all of those four are sort of intertwining factors, and we have to really watch out how they play out over the course of next few months and quarters to see real impact on us. At a at the risk of saying at a superficial level, the tariffs appear to support us in terms of increased traction for US market specifically, but over medium to long term we really have to watch out for how all these four factors will play out to understand real impact on the business.
What has been the currency and the strength of the dollar impact for you this quarter, Mr. Kotecha? Because that is one factor which will continue to dominate into Q4 also, one assumes.
Yeah. No, so in general, look, given we are export heavy business, we are a net exporter. I think currency depreciation helps us. You've seen some impact on PAT this quarter, and could potentially also be there in Q4 because we have certain ECB loans for which we have to take mark-to-market losses. We have to recognize liabilities from accounting standard point of view on that day basis versus the actual cash flow out happens over the course of almost 9 odd years for us. But in general, as a business, I think currency depreciation helps because from a long-term business profitability point of view, top line, bottom line point of view, it's positive for us.
All right, thank you so much.